Welcome to the Get Real Podcast, your high-octane boost of in the trenches, tell it like it is reality therapy for personal, business, and real estate investing success. With your hosts, powerpreneurs, Angela Thomas and Ron Phillips. It's time to get real.
Hey, everybody. Welcome to the Get Real Podcast. I am your host, Ron Phillips, and man, I've got a fantastic show for you today. I am really, really pumped about today's episode because I've got my really, really good longtime friend, Jon Galane, with me. Jon, welcome to the show.
Ron, thank you so much for having me. It's been a long time, and I feel so close, even though we're so far.
I know, man. I know. This is so. Let me give Jon a proper introduction. Jon and I travel. Most importantly, well, let me do the boring stuff first. Jon has been in the financial services industry for like 4 decades. It's got to be 4 decades.
Oh gosh, yeah, it's running about 40 years. It was 2003 when I entered.
I mean, the guy has.
1983.
Yeah, so it's been a minute, and anyway, his history goes back to the stock market. He was a VP for Morgan Stanley for quite a while, and then he transitioned into alternative investments, which we're going to talk a little bit about today. Founder of Mountain West IRA, which is the IRA custodian that we send all of our people to. Fantastic service. They've been doing that for 15 years. He and his wife Lisa run that, and it is of all of the companies, of the IRA companies that are out there, his company has the best level of service. Period. End of story. We really, really love working with them. Most importantly, Jon and I spoke together on the road to thousands of people over a decade. Over a decade long, we spoke all over. We were like the traveling circus. Jon and I educated people about alternative investments, IRAs, real estate, you name it. And we had an absolute blast doing it. And it is really fun to have you on the show, Jon, to be able to kind of get the team back together after it's been a long time, man. Good Lord, how long has it been since we've been on the road?
Oh gosh, it's got to be probably 6-7 years, maybe.
Yeah, it has been way too long. So, guys, get ready. Jon is a wealth of knowledge. I wanted to bring him in to talk a little bit about just the markets and things like that. I think anytime when everything's going really well, everybody's a genius, right? Because they're making money in the markets. When things start to get a little crazy in the markets, then people who really are geniuses with the market, Jon is the person I go to when I don't understand what the hell is going on. I say, Jon, what is going on? And then he explains it to me, what's going on. So I thought we'd talk about a few things. Number one, just really quickly, how Jon sees things right now, and get his thoughts maybe on the real estate market a little bit as well. But then I want to talk about the financial service industry just in general. Some of the things that you guys probably don't know that Jon knows from being in the belly of the beast for so many years, right? And he's not a hater on the stock market, but he does have some really, really good knowledge about what goes on there. And then we'll transition into some alternatives and talk a little bit about that segment. So, Jon, tell us a little bit about. We were just talking about dead cat bounces not too many minutes ago, and I was telling everybody, or I was telling Jon that felt really smart because I knew what that was, because Jon educated me years ago about what it was. But talk to us just a little bit about what you think is. Give us a quick down and dirty of what you think is going on and how you think real estate will fare.
Well, I have to tell you, this is probably the most fascinating market of my life. And when I say fascinating, I say it in a positive way, because we've become so complacent in our investing. We either have a totally down market like 2007, 2008, or we have a totally up market like we did right before coronavirus. And sometimes it's good for the market to shake up and for people to get shaken up a little bit. Granted, things aren't perfect as far as business is going, and the shutdown is just a horrible thing. The unprecedented loss of jobs of 16.8 million in 3 weeks is like something that's never happened on the face of the earth before. So the ramifications of it are enormous as we go further out with the economy being closed down. And what I think has happened is people are so desperate for something positive to happen that the market is an easy target to go back into. We saw it go down at the beginning of coronavirus when everybody got scared. We saw it come back when people thought things were getting better, when the graphs that they show on all the news channels every day, the curve is flattening, the curve is going down, deaths are going down. It's just, there's a lot of morbidity in how they're discussing coronavirus. And I think they're missing the psychological effect of what's going on. I'd like to see more of that and less of the charts. Charts are easy. They're easy for people to grasp because it's a bar and a line.
Yep.
This is so easy to grasp. And that creates a nightmare in the market. And here's where I think the instability is. I think that psychologically, the market has built in coronavirus and that it's going to be here for a while. And I think that people are getting used to that, and we're seeing the market come back up. And you talked about a dead cat bounce. I happen to be one of those that what hasn't been valued into the psychology of the market is what happens when we have another report coming out today or tomorrow on another 6 million jobs lost. And I don't know what it'll be, but let's assume that's kind of what it has been. What happens then? And what happens when the economy still isn't open? And what happens this? And what happens that? And what happens with coronavirus? And I think that that psychology of getting the market open and not the market, but the economy open and running again is misconstrued. I hear political analysts talk about, it's a V recovery or a U recovery or an L recovery. Okay, I'm going to do something that's inappropriate on a podcast, but like, who cares?
Yeah.
It's so important. You get up in the morning, you want to know, are you safe? Is your family going to be healthy? And is your money going to be there? Right? Your future. Yeah. People think about their future and they think about right now. They could care less about U's and B's and L's and all the other stuff that gets spewed on TV. So when we talk about dead cat bounce, which you and I were talking about earlier, is I think that the market has not built that in. I think that what's going to happen on this economy open is it's going to be slow. I don't think it's going to bounce back as quick as some people are saying. I also don't think it's going to be as detrimental as some people are saying, as long as we start getting people back to work.
Yes.
I was amazed at the 8.5% drop in retail sales. That's huge. That's like depression kind of huge, 1929 kind of big, and that coupled with the job losses are a big thing. So I think that the market is being unduly supported. I think there's a lot of volatility left. I think that volatility is going to be with us way past the election. A lot of people talk about election year volatility. What?
So these people who have been out there, Facebook, all the social media sites, people are out there, man, it's time to buy, it's time to buy, it's time to buy, because everything's going to go back up. If I heard you right, it may not be quite time to buy.
Well, it's always time to buy. When you and I were talking, you would hear me say, because I love the stock market as well as I love real estate and other alternative investments. It's always time to buy. But you have a choice. You can either be a bull, a bear, or a pig. So if you're a bear, you just stick with what you have and go to sleep and hibernate through this whole thing. And don't worry about it. Don't sell, don't buy. If everything's already invested, stay invested. If you've got cash, diversify. Don't put it all in the stock market. Don't put it all in one place. Look at real estate. I happen to think that the stability in real estate, and we'll talk about that in a few minutes, but the stability in real estate is much better than the stock market right now.
Yeah, I happen to agree.
So, the in the stock market is if you're a bear and do nothing, you're fine. And I can tell you that I'm a bear right now. I've done nothing. I'm not a seller. I'm not a buyer. I'm just kind of watching. Yeah, I know the market's going to go up, but I'm also 60 years old. So I don't care if it's going up in 5 years or 2 years. It's going to go up. I'm already good with where my investments are. Okay. The other thing is you can be a bull. If you're a bull, it's like buy now and just let it ride. Right? And deal with the down. If there's a downturn, buy more.
Right. Keep what's
and
invested,
prepare yourself.
buy more.
Yeah. When you prepare yourself that if you buy now, you could have a 20 to 30% drop somewhere in the near future, depending on what happens with the opening of the economy. Okay.
Yeah, and the most important thing, John, I think that people don't realize, the majority of the people out there who, just regular folks who are just they got money parked and it's in the stock market, is not to freak out.
Right.
It's because if you sell, how many times do we do presentations where we're telling people, look, if you sell at the bottom, you've locked in all the losses. Right. And then when you buy back in, you're buying back in with lost money to try to gain money. It doesn't work that way.
That's the pigs. I talked about the bears, the bulls, and the pigs. The pigs get scared and sell when it's low, and they go back in and buy higher. So they have a guaranteed loss always in the market.
Yep.
So, if you're a pig and you think now is the time to buy because it's only going up, what's going to happen is you're going to go in with everything. You're going to buy in that market because you just know, it's the cat's meow. Yep. It's going to beat everything. And as soon as it goes down, being a pig, you're going to get scared and you're going to sell. And you'll continue that cycle of buying high and selling low until you've lost everything. Yep. I kid you not, I've watched clients do this. When I was with Morgan Stanley, I begged clients not to do this. I watched a guy buying on margin build an account up from next to nothing up to $1 million. And I asked him to stop buying on margin at the levels he was buying. It was too high a risk in a market that was becoming volatile. And he was just convinced it was doing nothing but going up. He managed in about a month's time to lose all $1 million and end up owing Morgan Stanley $40,000.
Unbelievable. It's unbelievable.
So that's what happens with pigs. Don't worry. It's going to be okay. Now, let's switch from market to real estate. If you're okay with that, Ron.
Yeah, that'd be great.
The advantage of real estate right now is interest rates have never been lower. And I can't believe I'm saying this because in 2008, 9, 10, I was saying interest rates they just can't get any lower.
Right.
But here we are at a 0 to a 0.25 overnight. It just doesn't get any lower. It's the greatest buyer's market in real estate there is. And you're saying, whoa, wait a minute. You're saying it's a great buying market, but prices are up so much. Yes, they are. Your cap rates are low, your prices are up, but people are going to need places to live.
Yep.
Always going to need places to live. Businesses might be changing how they do things. They might not have as much physical presence in buildings. So I think that if I were a betting man, I'd probably bet with residential over commercial right now.
Yep. I agree. I actually think there's going to be a little bit of a shakeup in the office space market.
I've seen it every decade. It happens every decade. I remember when the oil crisis in the 70s shook up. I mean, Houston went belly up. There were so many empty buildings. I remember in the 80s, the JBL fiasco when they came in and Reagan changed the taxation on investments. That weren't really investments, they were tax write-offs, destroyed the commercial market. I saw it in the 90s when we had a downturn in the 90s with Clinton, and saw it again. And commercial it was like a ghost town for a while, And then we saw it again in the 2000s, in 8, 9, 10, when it was just, so it's not unreasonable that here we are in the next decade, and we're going to see another major commercial shakeup.
Yeah, I agree. Well, I've been telling people too, John, when we were speaking for the last 10 years, we would update the graph of new construction, which was basically non-existent for almost 5 or 6 years. There just
Remember that.
Because the population growth continues to grow and we weren't building anything really relative to population growth. We finally started to, climb that hill, but even still, there wasn't a big spike. And so many of the places across the country still have a shortage of housing. It's not as if, everybody runs back to 2008, wants to talk about 2008. This is not the same market. It's just not. We've gotten this crazy market that we were just talking about because of coronavirus, but the real estate market and the underlying real estate market is not the same, not even close. People have equity in their properties right now. They're not stuck in these crazy mortgages that we had before. Most of them are fixed, long-term, very low interest rate loans. In addition to that, we don't have a glut of homes in almost anywhere. We don't have a glut of homes on the market. And it's not propped up by a whole bunch of investors that were speculating on appreciation. It is entirely different this time. And so, I happen to agree with you about the real estate market. Go ahead.
Let me real quick on that, the difference between 2007, 2008 now, and the dramatic difference. That's kind of the technical side of it. And you gave the overall umbrella picture, which you're absolutely right on. But technically, in 2007, 8, for 2 decades prior, wirehouses, the big, like the Morgan Stanleys and JP Morgans and Goldman Sachs and Bear Stearns and, everybody that went under, they were separating out mortgage interest from assets. And they were selling the assets separately. They're what's called tranches. And they were selling, remember this when we were talking, how I'd go through the tranches and how devastating this was? They were selling to one group of people the interest. So people were earning interest with no underlying asset.
Yep.
And they were selling the assets to other people. And that's what created the whole problem that finally hit in 2008, is as soon as interest rates crashed and as soon as the real estate market crashed, there was no asset to back up interest. So they couldn't pay the interest because people were losing their homes, and there was no assets for people to take and either foreclose on or sell or anything.
Right.
So it just ripped the market to shreds. What you have now, completely different. You have a very stable real estate market with long-term fixed interest rate, and the assets and interest are not apart. They're together. Wirehouses can no longer split those tranches. They're not allowed to do it anymore.
That's important. And I think most people don't know that. I appreciate the explanation, a little bit deeper dive into that, because they don't report things like that. They report high level, and they also report national numbers, which are irrelevant. In the real estate world, national numbers are, though they're irrelevant. They don't matter, because just because some market is inflated doesn't mean that the 80% of the rest of the country is inflated as well. It's just not true. And we saw that very well in 2007 and 8, where a lot of areas were not inflated, and they got brought down because of the technical pieces that you just talked about, because of the banks, they got brought down.
Yep.
Those economies and those real estate markets actually they shouldn't have gone down. The only reason they went down was because of the technical aspects that you just talked about.
Yeah, and that's correct. That's exactly what happened. I mean, there were markets, gosh, you and I could probably name a dozen off the top of our head. Like Boise,
ones
Idaho,
that we were buying in
Kentucky,
2010, 11, and 12.
Huh?
The ones that we were buying in 10, 11, and 12.
Yeah, right.
Yeah. So, John, let's talk really quickly about, since you were so deep into, and kind of still are really, in some degrees, into the financial industry, I think there's a lot of things that people should know, but that they just don't know. One that I'll never forget that you explained, I'd love for you to explain it, is just this phenomenon of average returns, and that everything works out magically because the average return is 10 point whatever it is, or 12, or whatever they tell you.
Yeah.
And when the average person out there opens their 401k, their average return is never what these financial companies are allowed to say the returns are.
That's
and
right.
The disparity between the two of those is in some cases stark. And yet those companies don't get in trouble for saying that their returns average 12%. Why is that? How is that? And then let's just talk through some of the other things that people just don't know about this industry, that are kind of hiding in the corners or behind the scenes, that people just don't realize that are there.
Well, there was two questions that you asked there that are basically about an hour each. So I'm going to try and make them about
shrink them down, John. Shrink
so
them down.
What I was talking about, what you were just talking about on the average rate of return that companies are allowed to report is in mutual funds. And what happens is mutual funds are allowed to report their average rate of return over 1, 3, and 5 years based on the buying and selling of mutual funds without the losses added in, or without the tax ramifications, because a lot of funds will turn over 200, 300%. And those turnovers are all taxable because they're short term. They're all taxable at the individual's tax rate. And they're allowed to report figures without calculating taxes. And what happens is on those big return funds, you've got to, if you're in a 30% tax bracket, your average rate of return has to come down 30%. So if they're reporting a 5-year average rate of return of 10% average over 5 years, you've got to reduce it by 30% a year, which takes it down somewhere to between 3 and 7%. If it's not in a tax deferred type of situation, if it's in a tax deferred situation, those returns are returns. But it's what's called window dressing, and they're allowed to sell at the end of the quarter. They sell all their stuff with big gains to jack up the return. So at the end of the quarter, when they report their quarterlies and their annual and their 3-year, they use window dressing to increase the returns. It's been done for 50 years in the mutual fund business.
Yeah, it's insane to me.
And it's legal.
Yeah. Now, if I did that, I would go to prison. So
yeah,
it's remarkable to me that they can do that, right?
Yeah.
And if on real estate syndications, if I have a syndication company,
yep,
and I have on my website that our average return is X, and it's not, the SEC will come and get me. They will sue me, take everything I have,
right,
and then they will put me in prison to boot. And yet, this other place where you get to play, these other people get to play in this other world where they don't have the same rules. It's nuts. But I think most people assume that they have the same rules because they should.
Well, yeah, they assume that. And here's the situation. If the real estate market was allowed to do what the stock market did, let me tell you how the returns would look. And this is in a tax deferred situation, because I deal with this all the time. I talk about it. You've heard me say this. You're going to remember this when I say it. If the rules in real estate and the stock market and mutual funds were the same, whereas you could report a 10% average annual return over 5 years or 10 years in a fund, which most funds average out between 8 and 12. Once you're done, which they also don't have to report there's fees. There's certain fees that don't get added in there.
Right.
In their returns. The returns are gross returns. Okay. But if you were allowed to do the same thing in the real estate market, your average rate of return on a cash on cash piece of real estate might be 3% per year. So an average of 3%. But if you're allowed to put your financing in there and account for the interest that you paid, your average rate of return on a piece of property that's got a 60% loan or a 70% loan on it, goes from 3% to about 30% average annual. So
Right.
if you were allowed to do it, dollars to dollars, and allowed to do the same thing in real estate as stock market, and I obviously don't have time to draw you charts and show this, but you've seen me do it, that a piece of real estate that cash on cash is returning 3% per year average annual, the total return after a 10-year period on that property is closer to 30% using lending.
Right.
And you can't margin mutual funds. You can margin stocks, but you can't do it in a tax deferred account. You can't margin stock. You can margin real estate. You can get loans on it, and you can create those higher returns. Now, when I say 30%, I don't want anybody to think I'm talking hypothetical. So I'm talking on a hypothetical piece of property. Don't anybody come back and say, he said I can get 30%. No, I'm saying that if you do it correctly and you've got good properties, you could do that. But if you were allowed to report the same, the reporting on real estate would look so much bigger.
Yep.
But you're not. You're not allowed to report that. You're only
100%.
allowed to report cash on cash return.
100%. And then, you talked about taxes. There's also, the taxes and fees that come out that are specific to that company. All of that stuff comes out before it goes to you. And then it's my understanding they don't have to report on any of that. They report the top number.
Well, they don't report the taxes. They have to report some fees, but they don't have to report all the fees because fees are individual per client. So the SEC goes, oh, you don't have to worry about reporting that because there's no way for it to be exactly right. That's ridiculous.
Yeah, it's absurd to me that they're allowed to do that. And, yeah, well, so you're right. We could probably go on for 2 or 3 hours. I'm going to have you back. We're going to have to talk about some other stuff.
Well, let me answer that. The first question you asked me was average rate of return over a period of time. There is no period in history in America where the average rate of return in the stock market or the real estate market has been under a 10% average annual rate of return.
Yeah,
no
it's calculated unequal. Yes.
Even the Great Depression. So now, not everybody has 30 years, but you have to keep that in mind that if you've got a long-term horizon, that there is no reason your return shouldn't even out between losses and gains. And you're not going to win on everything. Every good investor knows that the goal is just win on more than you lose.
Yes, it's about getting on base. I talk about it in baseball terms, right? You don't have to hit a grand slam home run every time you stand up at the plate. You can bunt. You can hit it into the outfield. Doesn't make any difference. So long as you get on base and you continue to get on base, you advance. And that's the name of the game. I think also, John, if we're being fair, I'm a fan of beating up the stock market. I know you're not, but I am. I really don't understand it the way you do. So I like to brutalize it just a little bit. But if we're being fair, the same thing happens in real estate. A person goes and buys a piece of real estate. They have some things happen to them, right? They have a vacancy. They have a high turn cost.
Yeah.
And so their short-minded self gets in the way of a long-term investment, and they sell, lock in losses where they should have just stuck it out, and kept that investment long-term. And time heals all real estate woes, they say, right? So the same thing that happens in the stock market sometimes happens in the real estate market too. It's unfortunate that people don't have a long-term view of investments as they should, because they're investments, right?
It's part of the right now economy we're in.
Yeah.
Because of social media and because of technology, people expect everything right now.
And I think it's one of the big myths about real estate because of HGTV and all these gurus that go around telling everybody that you can make $1 million in 3 months, working 4 hours a week, flipping real estate, right?
Yeah.
Same thing that they do with stocks, right? You do all this really cool, crazy stuff with stocks in
no way to lose
a day, and if you use their system, you can't lose, and yada yada, right? It's such a bunch of crap. But here's the thing: when that overshadows, it's easy for people when they come into real estate and actually talk about real estate investing to think that those things are investing. You and I know it's not. That's a business.
No, that's trading.
Yes, that's That's the same as Publix has groceries on the shelf. That's what you're doing. You're buying something
you're
at a
trading
discount.
commodities.
Yes. And so that's
You're
not
trading
investing.
commodities for cash. You're not building a net worth. You're not building a future. You're not building security in case of a down market. It's not investing. It's gambling.
Absolutely.
It's day trading on the market, and flipping houses it's a commodity. You're just buying and selling a commodity, and commodities, as we know, if you're in the if you happen to be in the airline industry today, you understand commodities better than ever in your life, losing $10 to $50 million a day.
Yep.
You know, it's that's not investing.
So, Jon, let's talk a little bit about to kind of bring this thing home just a little bit, what we've been talking about today, because we talked about stocks, we talked about real estate, we talked about the markets, both stocks and real estates. I introduced you as the founder and owner of Mountain West IRA. Let's talk just a little bit about alternative investments and how it works, because so many people out there still, even though this has been since the 70s, you could do this with IRAs. I can't remember exactly what year.
Since 1975.
Okay, so since I was 1 year old, you could do this, right? So my entire life, this is something that people could do with their IRA, with their retirement accounts, and yet still millions of people don't know. And man, that should tell everybody out there something about how much of a hold the financial services industry has on the media and everything else out there, right? Because they don't want people to know about this because they can't sell these things, right? So there's no stockbroker that makes money by you investing in real estate, for instance, in your IRA, or any of a number of other things. There's tons of things. And I'm hoping you share one of your many crazy stories about what people have done inside of their IRAs with.
Oh God, I got so many.
So give us a high level how this works with alternative investments, and then maybe we'll have you come back and do a deeper dive about how it works. But give us a high level about what this is that I'm talking about.
Okay. In investing inside of a self-directed, by the way, all IRAs are self-directed. Just because it's at a brokerage company doesn't mean it's not self-directed. You're responsible for all the investment. Right. Whether an investment advisor does the investing for you or you do it yourself, it's all self-directed. So the law allows inside of an IRA, if you have a hard asset like real estate, that you can borrow money. It's called non-recourse loan. And I won't get into the whole thing today because it's a separate session, but you can borrow and leverage your real estate inside of an IRA and create greater returns, as well as creating 1031 exchanges. And on the amount that's borrowed, there's a tax on that called a UBIT tax, and that tax can be carried forward against future gains. It's very cool. But
now, real quick, Jon, it's important. Jon said the word borrow. Everybody in the normal world thinks that's the same thing as when they go borrow money from their 401k to buy real estate. What Jon's saying is completely different. I just want to make sure everybody understands. Jon, real quick, what are you talking about here that's different?
What I'm talking about is the IRA itself takes a loan, and the IRA is responsible for that loan on the piece of property. So the lender has no recourse against you individually or your IRA. The only recourse they have is against that piece of property that was borrowed on.
Okay, so
you don't sign personally. It doesn't go against your credit score, FICO, anything like that.
So for everybody out there who's never even heard that they could buy real estate in their IRA, we just blew their minds up. Like they just exploded out there.
Yeah.
So not only did Jon just say that your IRA can actually buy real estate inside of your IRA. So we're not borrowing money out of the IRA to go buy real estate. The IRA is actually purchasing the real estate just like a stock.
You're not distributing anything out of the IRA. You're not
no taxable event.
Advantage.
As a matter of fact, what Jon said is that your IRA can go borrow money just like you can to buy the asset, which means you can leverage it. And then rather than having the taxable event, you can actually, when you sell that property, you can use the laws of the 1031 exchange the same as you can personally. Your IRA can use it to push those taxable events forward inside of your tax sheltered entity.
Yeah,
It's insane.
sheltering.
There was a lot in there. I tried to unpack a little bit of it.
That is a 2-hour course that we just
I'm telling you, this is so cool, Jon. So most people don't realize you can do alternative assets. And here's the thing. I've had a lot of people, Jon, what you were just saying is true. So I go to my brokerage house that holds my IRA, and I say, hey, I need a self-directed account. And they go, well, this is a self-directed account. Oh, okay, cool. Then I go home thinking I can invest in real estate with my brokerage account at wherever, Smith Barney, right? But I can't. They're telling me it is a self-directed because it is self-directed, like you said. But this account that you're talking about is a specialized, not necessarily a specialized account, but it's held by a specialized brokerage that allows you.
Well, it's not a brokerage. Brokerage firms can't hold truly self-directed real estate accounts because brokerage firms fall under the SEC and NASD, National Association of Security Dealers. They have certain laws and they can only sell approved product. So you can't go to a brokerage firm and put real estate in your IRA. What you have to do is transfer that IRA to someone like us, who is an IRA administrator and trustee. We hold the funds. We sign the documents for the real estate. We don't hold any marketable securities, and that's why we can do this, because we don't carry the NASD license.
So companies like yours don't sell anything.
That's correct.
Right. Okay.
That's correct. We don't sell any product. All we do is administer what you tell us to buy.
Okay.
And it could be real estate. You could be a lender. It can be, there's so many things. One of my favorite stories, talking about stories on this, if I've got a few minutes and everybody's kind of got the concept of it. My favorite story, as a matter of fact, I trademarked it. I love it so much, is we have a client who buys cows in his IRA.
Like cattle.
Cattle.
Actual cattle. He's not buying ranches.
Cattle.
He's actually buying cattle.
Yes. And he started years ago. Gosh, must be about 10 years ago now. He started with a cow, milk cow. And he buys the cows and he leases them to a rancher who takes care of the cows, who milks the cows. And the income from the milk goes into his IRA tax-free. And each cow bears one calf a year. And that calf, if it's a cow, brings in $2,500. If it's a bull, brings in $3,000. That's what I call a capital gain. So it's about 100% capital gain minus food and vet bills. So you got 100% gain on a capital gain on each cow that's birthed.
Nice.
Plus you have income every month on the milk production. None of this is hands-on. They're all leased to a rancher that does all the work. And the rancher gets, paid for doing that. He now has, I don't know the exact amount, but he has gone from one cow in 10 years to about 300 head of cattle. So imagine what 300 cows milking each day, which I call a bovidend. In stocks, we might call it a dividend, but I like to call it a bovidend. And so each cow creates a bovidend each month, as well as a capital gain each year.
That is
just
fantastic.
Like real estate. By the way, cows and rental properties are exactly the same. I used to call my renters, somebody got upset with me, but I used to call my renters bovidends because they produced bovidends for me.
So that is a really good story. That even beats the fishing license story that I heard.
Oh yeah,
which is also a great one.
Yeah, he sold that license. He bought that license. I'm trying to remember now, for about $140,000, and had somebody fishing that license. He made a ton in dividends, in monthly income on the fishing of the license. He ended up selling it for almost $1 million.
Unbelievable.
Yeah, so it's a huge gain for him.
So The moral of the story here, guys, is that if you're sick of being trapped in a world that you don't understand, where you have to count on someone else to, I guess, pick the right stocks or the right mutual funds or whatever, and you want to take control of your financial future and, you know, your retirement accounts, then you can use a company like Jon's Mountain West IRA to do that for you. You just tell them what you want to do, and then they sign the documents, transfer the money, and whatever. So in this scenario, if you wanted to buy a cow, well, then you would call up the office and say, I'm gonna do this cowpital gains and bovidends deal, and I'm gonna buy a cow and lease it out, and all of the money goes from your account to whoever you bought the asset from. In this case, it was a cow. And then when you lease it out, all of the money from the leasing goes into your IRA. Doesn't come to you, it goes into your IRA. And
tax
it's really,
deferred
really
or
cool
tax
because,
free if it's a Roth.
interestingly enough, Jon, you said this is just like real estate, and I think maybe that went over some people's heads, but it is exactly like that. If you actually go back and listen to some of the podcasts in the past, we talk about people who bought one house or one fourplex, and because of appreciation, capital gains, the thing increases in value. You can sell it, and it can birth 2 or 3 other investments or other cows, right? It really is very similar. It's probably not on the exact same cycle as the cows, though. The cattle seems like it might be I mean, you got to keep the things alive. I guess that's the difference. Right?
Yeah. I'll tell you one quick story. When I was
What's
a
the
kid,
depreciation schedule on those things? That's what I want to know.
They are depreciable, by the way.
Are they really? What is it? 5 years?
Life, yeah. And I don't know what their life is, but yeah, they are depreciable.
Unfreaking believable. You can depreciate a cow.
But not inside of an IRA because, because there's no taxability, so there's no depreciation.
Oh my gosh, that's hilarious. Okay.
But yeah, you can. But interesting story. I had when I was a kid, I had a friend who he bought 2 cows with his father. And my friend was a kid. We're kids, but his father bought the cow with his grandfather. And I'm over at their house one day. Guy must be about 14, 50 years old. And the father's talking to the grandfather. He says, how's our cows doing? And he said, well, he goes, son, I have some bad news. Your cow died. Which they bought together. So, I always talk about, if you're going to partner, don't partner anything that can die, because all of a sudden your half might die.
That's right. That's right. Man, this has been fun. It's for me. I hope it was great for everybody. I know there was. There's a ton of information in here, but for me, this has been an absolute blast. Getting us back together. We're going to have to do this again.
Absolutely.
For everybody else too, because there's so much that goes into how this works, the intricacies of how these self-directed accounts work and what you can do with them. You're really only limited by 2 things, and your imagination. You can't buy collectibles, you can't buy life insurance, and you just have to be creative. That's really it. And short of that, you can pretty much invest in anything you want. They're fantastic. So again, Jon, how do people get a hold of you and your company if they want to reach out and ask you guys some questions or transfer some money into an account with Mountain West IRA?
Our 800 number is 800-377-3311. Our email is accounts@mwira.com. That's mountainwestira.com. We have offices in Florida and Idaho. And just ask for anybody in accounts or business development, and they will get on and help you immediately.
Awesome.
A couple of my favorites, of course, are Megan Galane, who happens to be my daughter, and Diane is
fantastic.
Excellent. Bianca is excellent, and so is Megan Brenneman. We have those are our top people. I highly recommend having a conversation with them. They're knowledgeable. They're sharp as tacks, and they will get it done and get it done right the first time and quickly.
Awesome. Well, we will put that in the show notes, guys. So if you didn't get that, just look in the show notes and reach out to Jon and Lisa. They're fantastic folks. Their team is amazing over there. They really, really do a good job. Guys, we've worked with, I think, every single account manager in the country. If not, we've only missed a handful, and they're head and shoulders above everybody else. Jon, thank you so much for your time. What an amazing 30-ish minutes, heavy on the ish, it's been today.
Well, we have so
really
much good
appreciate
stuff
it.
to talk about. And I just want to say, during the coronavirus pandemic, we are open for business.
Yes, so are we.
Rocking and rolling.
So are we, baby. No shutdown over here. No shutdown over here. Hey, appreciate you. We'll have you back. Guys, if you like the show, give us a thumbs up. More importantly, write us a review. Share this share this episode with everybody. Everybody needs to know that they can self-direct their accounts. So share this out on social media. We appreciate you guys. Don't keep us a secret. Until next week, this is Ron Phillips signing off.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.